I'm Janet Pritchard, and I'm the Director of Water Infrastructure Policy at EPIC, the Environmental Policy Innovation Center. And on behalf of EPIC, I'm very delighted to welcome you all to the first in EPIC's webinar series on SRF state policies. This webinar will focus on optimizing interest rates and other SRF loan policy terms. And it's based on a policy brief that you can access through our website, along with other policy briefs and explainers on the state revolving funds. The state revolving funds are a key resource to help communities around the country finance their water infrastructure needs. And given that the state revolving funds are primarily loan programs, state policy decisions about how interest rates are set play a key role in determining the value that SRFs can provide to make water infrastructure more affordable. So we're very excited to dive into this important topic with you. Now, I'm joined here by two of my colleagues from EPIC. Danielle Goshen is a senior policy analyst at EPIC. She joined us in 2024, and she focuses on analyzing federal infrastructure programs. She brings a legal background to her work, applying it to strengthen policy analysis and advocacy around water systems and funding. We're also joined by Jake Adams, who joined our team in 2023 as a senior advisor on conservation and infrastructure finance. Jake holds a Master of Public Administration degree with a professional background in municipal finance and management. His experience includes central accounting, financial modeling, and debt issuance for capital projects, including water and wastewater. And we're also very pleased to be joined by Marvin Cole Cheney from the Texas Water Development Board, who will provide us with a state agency perspective on our topic later in the program. And I look forward to introducing Marvin more fully when we get to his part. Okay. Now, before we dive into our topic, I'd like to give you a little bit more background about EPIC's water program for those of you who may not be familiar with our work. Our water program focuses on 4 key initiatives. Our Funding Navigator program helps communities access funding for water infrastructure projects. Our Green Infrastructure Initiative aims to drive faster adoption of green stormwater infrastructure at scale. We're also focused on accelerating lead service line replacement. And last but not least, our SRF program works to advance infrastructure investment with state revolving funds, with a focus on state SRF policies and tracking SRF funding. In my own role as Director of Water Infrastructure Policy, I lead our SRF work, and I'm also very involved in our green infrastructure and lead service line replacement initiatives. Now, when joining a webinar like this, it's always interesting to know who else is in the room. And we polled our registrants for this webinar, and we're pleased to see that about 1/3 of our registrants are folks who work directly in administrating SRF funds at either the state or the federal level. About 1/3 are technical assistance providers working to help applicants get access to SRF funds. And about 1/3 are folks that work in advocacy around water and water infrastructure issues, with a few applicants interested in SRFs joining our program or registering for the program as well. Please feel free to introduce yourself in the chat. Let us know a little bit more about your own particular interest in SRFs, and to share with other folks in the webinar sort of who's attending today. So with that, we'll get into our program. Just by way of overview, we're going to start with the presentations from Jake and Danielle, presenting some of the key insights and recommendations from our policy brief. Then we'll get some state perspectives from our panelists, Marvin, and we'll be sure to leave some time for Q&A at the end as well. You'll notice on our Zoom that we're using for this webinar that there's both a chat and a Q&A function. And we invite you to drop your questions into the Q&A thread as they occur to you during the course of our program, and we'll be sure to leave time for them at the end. So with that, I think we can dive right into our topic. And so I'll turn it over to you, Jake.
Great. Thank you, Janet, for that introduction, and good afternoon, everyone who's joining us. Great to have you with us. As Janet mentioned, a lot of the presentation today really centers around this policy brief that we worked on and published earlier this spring in April. So please, if you have the opportunity, you can find this on our website. Check out this great brief, a lot of in-depth information. This is really a cumulative study on a 50 state analysis, a really big deep dive into all of our SRF programs, looking at key terms about these programs, how obviously their interest rate structure works, length of loan terms, fees, and other really relevant program criteria such as eligible expenses, eligible projects, key application deadlines, and things of that nature. So you can find a lot of that information in this brief. Additionally, another resource we have available on our website are our SRF databases, which are really a first of their kind, a full 50-state deep dive and resource into all of these key terms and program requirements for all of the SRFs, clean water and drinking water. So I encourage you all to really take the opportunity to dive into some of these resources on our website. To sort of give the lay of the land of our discussion today, we're really focusing on the interest rate structures of SRFs, looking closely at how those structures are developed and kind of implemented across the SRF programs, the length of the loan terms, and then fees, which is another critical component of costs that go into an SRF loan. So as you can imagine, when looking at 50 different states and a multitude of different programs, there's a lot of variation. With interest rate structures, it's not an exact science in grouping these, but what we tried to do was categorize the methodology by which states create and develop their interest rate structure and how they assign interest rates. Obviously, the final rate is set upon an award being received by a municipality or utility. So we can't tell you exactly, what the end result will be in all instances, but we can give you a general picture of how the rate structure is implemented. Really, when looking across the states and all the different SRF programs, we were able to kind of roughly put SRF interest rate structures into one of two buckets. And those two buckets being a market-based interest rate structure or what we're calling a fixed rate structure. And I'll go ahead and throw out the caveat. We'll use the terms fixed rate and variable rate as part of our categorization. We don't necessarily mean that in the traditional finance sense, a fixed rate being a stable rate over the life of your loan versus a variable rate that may change and fluctuate. We mean that simply in how the rate structure is set up and how the rate structure is devised. So just some careful caveats there. With a market-based structure, to expand upon that, that is a structure that is discernible within the program intended use plan and other guidance documents that the rate is attached to some sort of market benchmark, whether that be a bond index, a bond yield curve, something that fluctuates with market conditions in the bond markets. So we saw that was, a pretty common theme amongst the majority of states, honestly. But then there's also a second group where we simply found a fixed rate structure for the year. So SRF personnel would establish a rate. It wasn't clear that it had any true or discernible underlying market benchmark. Rather, it could have been set by internal policy and needs for that SRF in repayment revenue streams. So, kind of a key distinction there. We found that generally the majority had some sort of market-based structure, but there are states that do not have a clear market-based structure. Within those two main categories, we also found a lot of sub-variation. So, for instance, your structure could be tiered. So you have various tiers of rates based upon the loan term length. A standard percentage discount from a market rate. We found that in a lot of instances where perhaps if it was a market rate based on an index, the standard rate was a certain percentage standard discount right off the top. So we found that was pretty common as well. Also, a lot of states utilize formula-based rate structure. So that may take into consideration project affordability criteria, median household income, other key demographic type data about the community or the system. and input that into a formula which assesses the final interest rate. So a lot of variation again, and I think you'll see that in the results here in a moment, but truly amongst 50 different states and lots of different programs, you see that. Loan terms, generally, that's the length for which the project is financed. So, we saw that some states, SRF programs offer a short-term planning and development loan, up to 5 years perhaps, that could finance some of the beginning pre-development work, engineering, other things in order to get a project ready to proceed. Those types of loans would then ultimately roll into the long-term construction financing or the long-term loan. Some states do not offer that with their SRF programs. So it was interesting to see that variation as well. And then fees. We'll also talk about fees. They're assessed in a variety of different ways. Sometimes as a one-time upfront origination fee. In other instances, as an ongoing administrative fee that almost acts as another layer of the interest assessed on the loan. So an ongoing fee based upon outstanding principal as you repay the loan. So a lot of key aspects here and a lot of variation, but I think the findings will kind of illustrate that picture. And then we'll dive in later on to some considerations and perhaps best practices and recommendations for how to structure a transparent interest rate structure. So again, just to summarize again briefly, the three main components we're looking at here are rates, fees, and loan length terms. So with rates, I like to think about these three things. Rates, first of all, are that represents the growth of your SRF. So state revolving loan funds are required legally to maintain these funds in perpetuity. They are a revolving loan fund that must sustain itself. So the rates are how you do that and how you continue to grow the SRF fund. If you make a loan and you simply return the principal amount, that doesn't account for discounting, that doesn't account for the impact of inflation over time. A dollar today is not worth a dollar tomorrow, or 5 years from now, or 10 years from now. Project costs will continue to escalate with the compounding impacts of inflation. So your SRF is not truly growing if you do not have a sufficient interest rate structure. I think that's very critical to realize upfront. Loan term lengths. So, that generally can vary from, again, a short-term planning loan all the way through a long-term 20 or 30-year construction loan. Term lengths, generally your interest rates are higher as the loan term is longer. And that's simply the case of over a longer time horizon, there could be a greater risk of default from a borrower. So that's just standard financial practice that generally interest rates are higher and you ultimately pay more interest for a longer term length. Generally also, loan term lengths, a maximum length of a loan should not exceed the useful life of the asset for which you're financing. So, financing a capital piece of equipment or a capital project beyond its useful life when it's fully depreciated and depleted is not good financial practice. Then you're paying off something that already has to be replaced. So keep that in mind as well about how loan term lengths are structured. But the longer term length does offer the benefit of a lower monthly payment for a utility or a community, and that allows them to make a project more affordable. And again, fees. I think I touched on that a little bit. Fees can either be generally one-time origination up front, assessed as rolled into the annual interest, if you will, as an ongoing administrative fee, or some combination of the two in our findings. And fees are another way and another tool for SRFs to cover administrative costs. These will go toward the actual cost of staff and personnel to administrate these loans, to manage these loans, and to manage the loan fund. So it's another important tool for controlling costs and ensuring that an SRF can grow over time. And with that, I'll turn it over to my colleague Danielle, who will dive into our findings a little bit further.
All right, thank you so much, Jake. So I'm going to be diving into these three policy levers a little bit more in depth. And as Jake already teed up, our interest rate brief went in and did a 50-state survey on all the different ways the states are responding to these different policy levers. So I will give some findings that we have from those 50 state surveys and then provide some recommendations that we have for states. So the first of these big policy levers, as Jake teed up, is interest rates themselves. So as he discussed, there's two main buckets. We have a market-based interest rate approach, which changes over time depending on the conditions of the broader financial market. And then a fixed rate, as Jake queued up, is a locked-in rate, and it does not change during the duration of the loan or investment. Now, there are different trade-offs that a state must consider when setting these interest rates. Lower rates generally reduce overall growth of revolving funds and increase access and affordability to the applicants themselves, whereas higher rates increase fund sustainability and leverage potential, but can discourage certain applicants from such as small and under-resourced systems from actually being able to access these SRF funds. So what we see among states is that interest rates vary significantly, and there's not a one-size-fits-all approach taken. Rates vary from 0% for some or all applicants to 4% for for-profit systems that we see in New Mexico. Nearly half of all systems provide discounts for disadvantaged communities, or DACs, under both the Drinking Water and Clean Water State Revolving Fund. And we also see that, as Jake mentioned, that the structure that is largely used by states is a market-based approach as compared to a fixed interest rate. So the different recommendations that we provided in this report are to first use a tiered interest rate structure based on community characteristics. States are not required to provide just one type of interest rate for all different applicants and projects. We really encourage states to align lower rates with systems that are facing affordability concerns or are otherwise disadvantaged. This might, result in an increase in administrative costs to actually administer the program, but we'll get to that later. Second, increased transparency in how rates are set and communicated. Please don't be one of the states that doesn't provide any information on their IUPs about their interest rates and how they're actually set. A few states do that, but we really encourage to provide, as much information to folks that are applying for SRF funding or are looking to improve the programs through advocacy. And we have to understand how those rates are set in order to do that. Thirdly, we encourage states to reevaluate rates periodically based on market characteristics and different equity goals or other goals that a program might have through its SRF administration. So, if you haven't looked at your interest rates in 5 or 10 years, it might be a good time to reassess that and see if it's working for your applicants and for the longevity of your program overall. Okay, second, we have loan terms. So as Jake discussed, a loan term is the length of time that you have to repay a loan, usually stated in months or in the case of the SRF, years. There is also a trade-off with providing different loan terms. Short terms typically result in higher payments for the borrower with lower costs, higher payments now for the borrower, but maybe lower costs overall. Meanwhile, longer loan terms typically result in lower payments, monthly or annually, and higher costs overall. So what we see across the states is that the majority of states provide at least a 30-year loan term, while nearly a majority also provide both shorter and longer terms. So there's, wide variation in whether a state provides 20, 30, or over 30 years. And most states have different loan terms that they provide for different types of projects. A few states provide short-term loans, meaning like 5 to 10 years in both the Clean Water and Drinking Water State Revolving Funds. And these are typically for planning loans, asset management, design, and interim financing. So what are our recommendations for loan terms? First, we encourage states to customize their loan terms. Again, really utilize that flexibility of the SRF programs. State SRF agencies, we encourage them to utilize the flexibility of the SRF programs to customize loan terms that align with the repayment capacities of underserved and overburdened communities. Meaning, really trying to understand what type of package is going to be most useful for those types of communities. Second, we recommend offering shorter term loans, especially for planning. This is really to help that project pipeline, in order to balance the needs of the state to maintain the longevity of the SRF program and to help communities also plan for their water infrastructure projects. Agencies should considering flexible loan terms for planning and other eligible projects that can be completed in a shorter lifespan. This will allow communities to move, from the comprehensive list to the fundable list, hopefully quicker, if they have that ability to get a shorter term planning loan. Third, we encourage states to consider the impact of both loan term length and interest rates. We encourage states to consider how extended loan term lengths might not be wholly beneficial for applicants. For example, interest rates are not also discounted for state defined, if they're not discounted for state defined DACs. Longer loan term lengths could result in communities paying more over time. So increasing duration isn't always wholly beneficial for the applicant. So understanding how the interplay of interest rates and loan terms impact the overall package for a community is really important. Okay, next and lastly, we have loan fees. This is the last policy lever discussed in our brief. Loan fees, as Jake mentioned, are extra charges that lenders, in this case SRF administrators, add on top of the interest rate when you take out a loan. These cover administrative costs, processing, or other risks that the lender will take on when offering loans. These fees can be one-time or ongoing, and they can significantly increase the true cost of borrowing, especially for already overburdened borrowers. So what do we see across the states? We have some general trends here. We see nearly a majority of states requiring annual fees, with a minority utilizing one-time fees or a combination of both one-time and annual fees. A small minority of states do not assess any fees with their loans. And around the same number of states do not report on their fees at all. So we don't know which category they fall under. And we have some notable policy outliers within this. And this kind of shows, some of the vast variation that we see across states. Mississippi requires a 5% of the loan principal or lifetime interest fee, and this is annually. Sorry, the interest is annual. In Maine, we see a 1% fee for project management projects, and then up to a 5% administrative fee that's also assessed annually. Then we also see different states have tiered fees, which is great. We don't have to provide the same type of fee structure for every applicant. In Hawaii, they require a 1.5% fee annually for municipalities, while a $1,000 flat fee for private applicants. Other states also allow fee waivers, which is great. If an applicant cannot, afford their SRF loan package with the associated fee, there should be some flexibility there if it's not going to, hurt the overall longevity of the program, or if it can't be, made up in other ways. Maybe allowing a fee waiver would be helpful for certain applicants. So as the slide shows, we see a lot of differences, not just in fee amounts, but also how they're structured and applied to applicants. For loan fees, we encourage 3 main recommendations. So first, again, ensuring transparency. We really encourage the states to provide information on their fees and how they're structured in order to provide, that maximum amount of clarity to borrowers. Second, importantly, many states don't utilize all of their federal set-asides. There's a 4% allowance for administrative set-asides that the states are allowed to take from the federal cap grants coming down from the federal government. So we encourage states to make sure that they are utilizing that 4% set-aside in order to help mitigate administrative costs of processing SRF loans, which can help keep fees lower, potentially, if they're not already using the 4% set aside for other items. Lastly, we encourage states to balance fees with interest rates and other flexible variable fees based on the applicant. Oh, no, sorry, and offer flexible or variable fees based on the applicant. Such as lower fees for DECs or priority projects such as urgent need projects. And with that, that's an overview of our 3 main policy levers that we discussed in our report and the recommendations that we provided within it. Now I'm going to pass it back over to Jake for an example of how these 3 policy levers can interact with each other.
Thank you, Danielle. Really appreciate it. So here, I like to have hypotheticals or examples to look at to really illustrate some of the concepts we're talking about. This is also a little bit of a plug or teaser for a blog we have coming out or maybe already out on our website as well, which dives into this specific topic a little bit further. But one other important criteria we didn't mention previously, but it comes up commonly when we work with communities as technical assistance provider, is also the kind of 4th layer of this is principal forgiveness. We are a lot of folks that are interested in what principal forgiveness is being offered through the SRF. How much principal forgiveness am I eligible for? Can I receive? But this is an important exercise here to look at the impact that principal forgiveness has, but also look at the impact of rates and fees as well, and see that reductions in interest rate can also have pretty pronounced effects as well on the overall payments. So let's just assume ground level, some basics for purposes of this illustration, that we have a $4 million 30-year construction loan that's been issued to an applicant. In the first scenario here, let's just assume a flat interest rate, and that could be comprehensive of fees as well, that your total interest, all-in interest rate comes to 2.5% with 0 principal forgiveness. So you can see the impact of compounding interest amortized over a 30-year period will have. You have not only the total principal repayment of $4 million, but approximately $1.7 million of interest that will be paid out over the 30-year term. So obviously, again, as we mentioned, the longer the term, the more interest generally. In the second scenario here, we look at the same principal amount with the same interest rate, but let's assume a 35% principal forgiveness award for this. So as you can see in the bottom line, that's a significant amount of savings, all things being equal. That's roughly $2 million of savings over the life of this financing. So that you can see why a lot of applicants are very interested in principal forgiveness when eligible. It certainly is an important tool for providing affordable loans and ensuring that projects are affordable for communities. Based upon need and based upon affordability criteria. In the third scenario, I kind of wanted to look at, well, let's just see what an interest rate reduction would have and what type of impact that has without principal forgiveness factored in. So if you amortize $4 million over 30 years at 1% interest rather than 2.5%, so let's assume a reduction in interest rate and or fees to get you to 1%. That's also a tremendous reduction. Not quite to the level of the principal forgiveness scenario, but that's over $1 million in interest costs that's avoided over the 30-year loan term. So also a significant tool. And I think the policy recommendation and argument we'd like to make here is that both principal forgiveness and interest and fees as well, are very important tools in how an SRF manages its loans and manages itself to sustain and grow the fund. But I think there's a lot of room for balance in using both of these very strategically. So in scenario 4, let's assume the same amount of loan with a 1.5% interest rate, but with half of the principal forgiveness of scenario 2. So 50% reduction in the principal forgiveness. That comes out to just over $4 million over the 30-year loan term, which is between $300,000 and $400,000 difference between scenario 2 and scenario 4 on your total repayments. And I think that's really important. You know, that difference over 30 years, if you average it out, is about $13,000 a year, or roughly only about $1,000 a month difference. The key takeaway here too, looking at the bottom line, in all these scenarios except scenario two, the principal amount is returned to the SRF. And that's something from a policy perspective we've looked at very carefully, ensuring that SRFs can sustain themselves and have sufficient capital to issue future loans and more loans, and manage ongoing escalations in project costs. It's important for them to recoup proceeds from loans in order to sustain themselves and make future loans for infrastructure. Scenario two provides a loss in principal. There's actually a loss from the total principal amount, where you can see a combination of strategic interest rate and principal forgiveness in scenario four leads to also a relatively equal affordability scenario for the applicant, but also the full amount of that loan being returned to the SRF over time. So I think it's just a really important example here to kind of illustrate how these tools all work together, ensuring both affordability for the borrower as well as longevity and sustainability for the SRF.
Oh, you're on mute, Janet.
All right, well, thank you, Danielle and Jake. And now I'm very pleased to further introduce Martin Cole Cheney, who joins us as from the Texas Water Development Board, where he is the director of the Program Administration and Reporting Division. This division assists communities in obtaining funding through the Texas Water Development Board's state and federal financial assistance programs, ensures compliance with program requirements, provides for the timely disbursement of funds, reports on the benefits of the agency's efforts in developing water projects for Texas, and supports the office's data and software system enhancement needs. Marvin has been with the Texas Water Development Board since 2009. He holds an MBA from Concordia University and a BS in Urban and Regional Studies from Cornell University. Thank you very much, Marvin, for joining us at our webinar today. And we're very, very excited to hear your own thoughts coming from the perspective of a state SRF agency.
Thank you so much for having me.
So, Marvin, we welcome sort of some overview comments from you on your experience with interest rates in Texas.
Absolutely. So our state revolving fund programs have utilized a tiered interest rate subsidy process since really the inception of those programs. The way that we factor in different types of financing options for our communities is whether or not they're pursuing equivalency funding or non-equivalency funding. So if they're pursuing the equivalency funding route, that is where we're applying the full broad breadth of the federal requirements to that particular project. It's one where we're going to be capturing those in our annual reports to the EPA as receiving federal funds, in essence. Those get the greatest interest rate subsidy reduction against market rates. And depending on the program, it's anywhere from 35% to 40%. The non-equivalency route would receive a slightly less interest rate subsidy against the market rates. So that will be in the clean water program, a 30% reduction, and in the drinking water program, 35%. And we also utilize a origination fee. It's a one-time fee that's applied to just the financing that's offered at the start of that execution of those agreements. It is between 1.75 and 2%, depending on the financial assistance program that they're pursuing. And it can be rolled into the loan principal or paid one time using the cash on hand that those communities have. And the funding that we assign to the rates that we assign are based off of municipal market rates.
Okay. Yeah, thanks very much for that, Marvin. And I have just a few follow-up questions as well. And I think Looks like some of these are oriented towards Marvin, and then maybe where appropriate, Danielle and Jake could jump in as well. So first question for you, Marvin, is Texas offers some generous loan terms to disadvantaged communities. And like we talked earlier in the program about the need to sort of balance the loan, the fund durability issues against offering discounted interest rates. And I wonder if you could expound a little bit on how Texas sort of strikes this balance to both meet those affordability needs and also secure the longevity of the fund.
Yeah, so we definitely want to and seek to make those projects for disadvantaged communities affordable for those communities. And we do offer 70% principal forgiveness for our disadvantaged eligible projects when we've got those limited principal forgiveness dollars available. In addition to that, we utilize that interest rate subsidy tiered system to really try and drive that affordability for the recipients. But we understand and have understood the need and the benefits to having the interest returned to us against the principal that we offer out so that we are able to revolve the program into perpetuity. Every year we provide a funding capacity analysis and cash flow modeling, which helps us to determine how the interest rates subsidies will be applied for that program year, and if we need to make tweaks to that or the origination fees. And we also take into account all of those different anticipated disbursements of funds that we plan on doing for that program year, looking at what ways we can do that in a way that maximizes the value, still draws in demand to the program funds, so that we can meet all the capitalization requirements that come with being capitalized by federal funds. And I did also fail to mention, we also offer in some limited instances 0% interest loans and financing. And it's very dependent on the type of project or if we aren't able to fully cover that 70% principal forgiveness offering.
So it sounds like in balancing these different concerns, Texas sort of is taking a very sort of dynamic kind of approach, of actively sort of monitoring all these different factors and balancing them in a very active way, as opposed to just setting static policies and let them play out. And that's very interesting to hear about, as I think it provides more opportunities to sort of tweak, as you said, as different concerns and considerations and also financial opportunities are arising. I wonder also, because I know that Texas also leverages its fund quite actively, and I wonder if you could explain to us what is the relationship, if any, between your leveraging practices and your interest rate considerations?
Yeah, it's definitely tied together. Leveraging allows us to increase the volume of financing we're able to offer through the program. With the funding that comes from the federal government, there's a potential there that it's not received, that the program isn't capitalized. And I think maybe that was a part of the original intention behind this program, was to do initial capitalization of it across the states, and then the federal government would step away. So by us having the ability to revolve the funds, collect interest, and then do leveraging, issuing those bond sales to have cash on hand ready to disperse to those projects as they're ready to proceed, it gives us that additional sort of protection for any dips that might come about from federal funding. And it is a process that gives us a greater chance to have more communities access the program, and allows for maybe those systems that might be in a better financial shape that could go out to the private market themselves to finance their projects, to see us as a potential option, as another valuable resource that they can access, which of course helps continue to have us be able to have a well-performing portfolio.
Thank you. And earlier in the presentation, Danielle and Jake were discussing sort of the different ways of setting interest rates. And how do you look at those different market factors and make decisions across, what kind of approach you're going to take in setting your rates based on, in relation to those market considerations?
Our agency does make use of a financial advisor, so that helps in that equation. And we actually have a debt and portfolio management division in our finance office that actually performs a lot of that work, reviewing the capacity models and helping us in the program office understand what our needs are in terms of program requirements, where we see the demand trending across the communities that seek our funding. And then we work in collaboration on an annual basis to establish those prior to publishing our intended use plan.
Mhm. And how would you recommend are good ways if whether it's applicants to your program or advocates interested in engaging with your program who wanted to understand better your interest rate policies and how they're set, or what the parameters might, what kind of scope there might be for reduced interest rates, et cetera. What would be your suggestions for how those kinds of stakeholders in the program can best engage on these issues?
Definitely looking at our published intended use plans and offering feedback when we have our open public comment period. We're actually in an open public comment period for our state fiscal year 2026 program cycle right now through September 14th. We also have our interest rate sort of estimates posted to our website, and that's an opportunity for folks to view what the likely interest rate might be on a supposed project at a 20 or 30-year term coming through the SRF programs. We have outreach staff as well that you can contact, and they will, I guess, be the initial receipt of any kind of questions regarding that with regard to a specific project need or a specific community's sort of financial condition, and then can navigate that to the correct parties in our agency that might provide additional information and resources.
Thank you. And as I mentioned before, it seems that Texas has a very dynamic and vigilant program around its interest rates and its leveraging. But what advice would you give to other states who maybe haven't been as active and as dynamic in considering their interest rates and their loan terms and fees? What are some of sort of your top tips, for peer, other state agencies, to consider if they want to start, reviewing and reassessing some of their own policies in this area?
Well, I know that my finance folks in our agency are happy to collaborate and share what things that we've encountered over the years. So you can definitely reach out to me and I can put you in touch with those folks. And if you haven't engaged with a financial advisor, that might be another opportunity to seek that market-based expertise on that issue and that matter, and specific to the markets that your state sort of is experiencing. Yeah, I think those are probably two of the biggest ones. I think too, EPA is a good partner as well. They've got a lot of resources available, and so reaching out to them isn't harmful as well. They've seen it all across the nation.
And I think that I've gone over some of the questions that have come forward from our audience. I wonder, Danielle or Jake, if you have any follow-up questions or things you'd like to mention to continue our conversation.
Marvin, you just sparked a question, but this might be completely ignorant, but I'm wondering, are financial advisors available to state SRF agencies at all through any TA programs? Not usually TA is associated with the applicants themselves, but is there any way that a state agency can, reach out to TA providers for that financial advising component?
Probably depends on state laws for each of those states. We have been an infrastructure bank in our state since 1957, basically. And so that is a component that has been associated with our financing instruments. So not just the SRF program, but the others that we manage as well.
Yeah, Marvin, I really appreciate you being here. Thanks for all of your input. I just have a question procedurally for how, in a lot of instances under the Safe Drinking Water Act, or now especially in the BIL era, where there's mandated percentages of principal forgiveness that are required by law to be offered through the SRFs. How do you view those funds through the lens of an SRF fund manager? how do you view those funds? Do you view it simply as pass-through that needs to be provided coming down from the federal government? Do you take into consideration the loss of that principal and the impact to the growth of the overall fund? Just what the perspective as a fund manager is on that Fed cap that you receive that's required to be passed through.
Yeah, I may not be the best person to answer that question because that is our debt and portfolio management division, but it is definitely something that has to be factored into the capacity modeling because it is a difference in terms of the interest that could be repaid to the program. The capitalization, though, from the Infrastructure Investments and Jobs Act is in addition to what the base programs were allotting. So that is more money flowing into the program's account.
Right.
But it does bear impact.
And we've had another question come up around loan fees. And my understanding is that the state agencies, rely on loan fees to help offset some of the cost of operating their program. But of course, there's also the opportunity to use set-aside funds from the federal capitalization grants to help cover some of those program costs. And I wonder how Texas, balances sort of decisions around resources for program administration and what's needed and how to balance those different sources for supporting your program.
Yeah, there are multiple variables and considerations that we have to take into account as the program continues to mature. And our particular agency has utilized the 4% set-asides from both of the SRF grant programs since the inceptions of developing our programs. And we've also had a origination fee, I believe, for that length of period of time as well as a reserve for our administration of the program into perpetuity. We've also made use of those fee accounts for different initiatives to provide technical assistance to those communities, in addition to what our sister agency, the Texas Commission on Environmental Quality, utilizes from the regular set-asides offered. And they've now expanded from just utilizing those for the Drinking Water State Revolving Fund program. We're trying to develop additional technical assistance offerings through the 2% on the clean water side. So we're trying to do everything that we can to make use of those funds to assist communities and continue these programs.
And have you ever considered, in relation to those fees, providing any sort of exemptions or waivers of fees like that for some of your applicants based on affordability concerns?
I think that's a part of considerations for us. Right now, we don't have a waiver process in place for those, but it's a part of the equation that we evaluate whether or not the market will bear an origination fee in addition to what the interest rate subsidies look like.
And I think that just underscores how in all of these decision makings, there's a lot of different things to balance. And I'm so grateful to you, Marvin, for joining our webinar and offering your perspectives. As I noted at the beginning of our program, we know we have in our attendance at the webinar folks from other state agencies, federal administrators and SRFs, and other advocates and stakeholders working in this space. And so I'd like to also open up the floor if there's, others who would like to, come off mute and offer some further perspectives, from other states or from your own experience around these issues that we've been discussing.
I don't think people can come off mute.
Oh, I'm sorry. I thought that we could. My
We
mistake.
can also pop in the chat, and if you can read it out loud if you have any perspectives that you would like to share from your state.
Okay. Let's see. Just going through to see if there was any other questions. So I don't know if anybody's taking advantage of that opportunity in the chat. But if not, unless there's anything further that Jake or Danielle would like to add, we can sort of move to wrap things up. So again, I'd just like to remind you all that this is the first in a series of 3 webinars that we're hosting in relation to the set of policy briefs and explainers that we've published on our website. The upcoming webinar dates will be September 18th, where we're going to talk about how states define disadvantaged communities, and September 25th, where we'll talk about the whole set of state policies that determine how principal forgiveness and other most favorable loan terms are distributed across their SRF applicants. And there are also our briefs on both of these topics, along with some further SRF policy briefs that can be accessed through our website on our landing page for SRF policy briefs and explainers, which I think you may have seen in the chat. And so we certainly hope that you will also join us in these other webinars as well, and share information about these with your networks. Please register for the other 2 webinars if you haven't already. And with that, I just want to thank you all for joining us today. We hope that you found this helpful, and we do certainly appreciate any feedback that you want to offer, both on our briefs, on our webinars, and on our program offerings generally. I want to again extend our thanks especially to Marvin Colchaney for joining our webinar and offering his very insightful perspectives from a state agency point of view. We know that Texas is a state that gives a lot of careful consideration to their policy in these areas, and we really appreciate it and appreciate the opportunity to lift that perspective up to our wider audience. And with that, I think that's the close of our program today, and thank you all for joining.